Welcome back. Today we're going to talk about Google and why I think it's a no-brainer buy at today's valuations. We'll take a look at a couple of things, starting with the financial metrics and their valuation at this point. Their various businesses, including Google Search, which is their business that is currently under attack, and we'll talk about why I don't think the threat is as serious as people say, or at least that it's not going to ruin Google as a company. Then we'll talk about the new AI model that they just released that seems to be beating all the other ones. We'll also talk about their cloud business and what their operating margins could look like in the near future, because their operating margins right now are average compared to their competitors. And then we'll take a look at the Waymo opportunity, which in my opinion is a huge opportunity. We'll also look at some of those antitrust lawsuits, and I'll kind of share where I think those are going and how that's going to affect the stock price over the next couple of years. And lastly, we'll do some projections on where I think the stock price is going in the next 5 years and give you my base case for that. Okay, let's jump right in. So starting with the financial metrics and the valuation here. So at a stock price of $154 today, the forward PE is a ridiculously low 17. And the 2-year forward PE based on the 2026 numbers from analysts, 15, which for a big tech company is ridiculously low. Compare them to all the other big tech companies. Anyways, if we look into some of these metrics here, the revenue pretty much growing 12% for a company this massive, still growing revenue 12% per year. The past 5 years, it's even faster, 16%. Okay, let's look at the revenue split up by segments here. As you can see, Google Search is still by far the biggest part of their business. However, if we, take all of these other ones out here, Google Search, right? This is the business that's under attack, that's being disrupted. What does that tell us? We're not seeing any sort of disruption yet in the numbers. The biggest part of their business is still growing over 12%. If we look at YouTube ads, it's growing even faster, almost 14% a year. And obviously YouTube, what other product really competes with them? None. And think about the content that we have started consuming. I think largely people are moving away from traditional media and, cable television into stuff like YouTube. And I think there's still a massive runway of growth ahead. Their Google network business has been kind of flat, just stagnating for the past couple of years. If you look at their other subscriptions, a little bit slower growth there in the past year, but um, still growing very, very nicely. Now, this is the exciting part of the business. Their Google Cloud business. They're one of the three big cloud service providers, right? Growing 30% a year, which is incredible. If we look at their operating margins here, you can see that, just a couple years ago, uh, this part of their business was losing a ton of money. But over time, they flipped to profitability, and now it just continues to rise. And we'll take a look a little bit later on where we can expect these margins to go and what that looks for, AWS, for example, which is a more mature, more established cloud business. Moving on, let's look at the free cash flow here. If we switch this to the trailing 12 months, just to smooth out any curves, right? You can see that their free cash flow over the past 5 years has been growing 18% a year. Obviously we like high growth and free cash flow because then they can either invest back in their business or they can do, they recently started paying a dividend. They can increase their dividend. They can buy back more shares, which they've been doing with these low valuations and this uncertainty around their business. So that's really good to see. Moving on, let's look at the net income, or let's look at the EPS, I guess. Really, really strong growth. And this just shows they've been taking so many shares off the market through buybacks, and that really boosts their EPS. Their cash balance, too. This is a company that has a massive amount of cash on the balance sheet, 95 billion. So obviously it's been dropping in the past couple of years as they continued to invest in AI infrastructure, mostly, but also buying back shares. But they have a ton more cash to go. So we'll have to see the next few quarters what they do with that, but this is a really good position to be in. Moving on, as I mentioned, their dividends. They've been paying dividends for 4 quarters now, so they just got started. It's what, 20 cents currently, but I expect that to grow as the company and business matures. Let's look at the return of capital chart here. So as I said, you see um, how many shares they're buying back. I think I switched this to back to quarterly. Yeah, so if we look at this, they're buying back almost $16 billion worth of shares every quarter, pretty much. And if we look at the shares outstanding, it's been dropping pretty rapidly. Okay, now let's look at the valuation here. If we look at the price to earnings in the past 5 years, you can see at the current valuation, a PE ratio of what, 19 roughly? This company is almost trading as cheap as it was during the 2022 crash. And lastly, let's look at the expenses. Um, yeah, it's growing over time, and you can see that a lot of this is CapEx. So obviously, as they continue to invest heavily in AI, this will continue to rise. We'll have to see. There's been a little bit of uncertainty around whether or not big tech is going to continue to invest so heavily in AI infrastructure. Um, but I would say that generally investors don't like to see this large capex, uncertainty. They're unsure about the return on the investment. So let's say they do spend less on capex in the next few years. What do you think they're going to do with all their cash? They're going to buy back so many more shares. And that's going to cause the EPS to absolutely explode. Okay, now let's go back a little bit. If we go back to Google search, right? Growing 13%, we got that. This is the business that's under attack from, ChatGPT, Grok, all these large language models. However, a good point that Joseph Carlson, a YouTuber, if you've never seen his videos, he makes stock market videos. I would highly recommend that you watch these great quality videos. He's been making a point for a very long time about this, the search engine market share worldwide. So the story has always been, this is going back to 2015. The story has always been that Google has this monopoly on search, you know, all search basically. And this is the chart that's always shown. You're comparing Google, Bing, Yahoo, Baidu, and whatever other. And the big story recently was that for the first time in 24, or I don't know, first time in a long time at least, their dominance, their market share dropped below 90%. And the worry recently has been around, ChatGPT and Grok essentially disrupting this business. However, the point that Joseph Carlson has been making for a very long time, and that I fully agree with him on, there are so many other players. Google's search dominance is not this strong. Think about, Amazon. When people go, there's a search bar, right? They look for products that's competing with Google. Think about Reddit when you go to look for those, I don't know, other opinions essentially. Think about X. That's a search bar that provides people with information that they need. There's tons of Facebook, for example, when you need something locally, or maybe you're looking for, someone selling something locally. There are so many other places that provide you with answers that directly compete with Google. So really, their dominance is not this strong. So that, along with the fact that we're not seeing this disruption in the numbers again, this, almost $60 billion business is still growing almost 13%, which is ridiculous. And not to mention, Google has their own LLM, Gemini, which we'll get into next, their new AI model, Gemini 2.5, which is beating everyone else. So I think those three factors make me think that Google isn't going to get disrupted. And the last point on this search market share and how LLMs are disrupting it, I think LLMs help grow the overall search market, not necessarily just take market share from Google. I use Google for certain things and I use LLMs for other things. And I think Google still has like a monopoly over local searches. So think about when you're booking appointments. Maybe that might change in the future, but I'm not going to ChatGPT to make my doctor's appointment or, find those places around me or whatever. Not to mention, Google has this integrated into a bunch of their different apps, like Google Maps, for example. Okay, let's move on to the AI model here. Gemini 2.5, our most intelligent AI model. This article goes on to say Gemini 2.5 models are thinking models capable of reasoning through their thoughts before responding, resulting in enhanced performance and improved accuracy. So remember the whole DeepSeek situation. That's what people were so fascinated with, the fact that the model could, in a way, like think through its own thoughts before and like share how it's thinking and reasoning before giving you the answer. And they explain that in the field of AI, a system's capacity for reasoning refers to more than just classification and prediction. It refers to its ability to analyze information, draw logical conclusions, incorporate context and nuance, and make informed decisions. Now, with Gemini 2.5, we've achieved a new level of performance by combining a significantly enhanced base model with improved post training. Going forward, we're building these thinking capabilities directly into all of our models so they can handle more complex problems and support even more capable context-aware agents. Then they go on to introduce Gemini 2.5 Pro. And this is the model, as you can see here, that's beating all these benchmarks, performing better than these different OpenAI, ChatGPT, Grok, DeepSeek models in various tests. The rest of the article goes on to, explain some of these test scores, how they're performing. It goes a little bit into the coding, and yeah. So that's not the point I'm trying to make here. The point I'm trying to make is that Google is in this AI race. Google was, investors talked about Google was being left behind. Um, for a long time, they were thought to be leading, but then ChatGPT came out, Grok came out, DeepSeek came out, and people thought that Google was being left behind. But this clearly shows that they're not. Okay, going back again, let's look at the cloud business. I talked about the future of their operating margins. So currently, their operating margins have been growing. I thought, in case you don't know what operating margins are, I pulled this up. Operating margin, what is it, and the formula for calculating it, whatever. Down here, what is operating margin? The operating margin measures how much profit a company makes on a dollar of sales after paying for variable costs of production, such as wages and raw material, but before paying interest or tax. So, from the point of sale, when a customer comes in and buys, capacity on the server to host their, let's say, website, right? Take that sale, subtract probably the depreciation of hardware, the electricity, the cost of the engineers making those solutions and maintaining those solutions. Subtract all of those costs from the net sales, and you have your operating margin. So currently, their operating margin is sitting around 17 or 18%. From what I've learned, an operating margin between 10 and 15% is healthy and good. And this for Google is still a young business, a young segment of their business. Not too long ago, this was losing a ton of money. And I made the point that Amazon is where this company might, or where this business segment might be headed. So look at these operating margins for AWS, almost 40%. So as Google Cloud, grows and gets to, I don't know if they'll get to the same scale that AWS is at, but I expect them to continue to grow and continue to expand their margins, as their fixed costs kind of, um, go away, but they continue to generate revenue, that operating margin is going to expand. And let's go back and look at the revenue real quick. Let's take out everything but Google Cloud. So last quarter, they made $12 billion, right? So over time, a bigger portion of that $12 billion is going to go straight into their pockets. That's going to expand or continue to grow their free cash flow, right? And think about how fast that revenue is growing, 30%. That's going to continue to grow their free cash flow. And that's going to continue to grow their EPS. And the EPS growth is, once we make our projections a little later in this video, uh, the EPS growth is what we use there. So the future EPS growth being strong is important. And when you think about the continued growth of this business segment, so this is from Grandview Research or whatever. So in 24, the cloud computing market was worth $752 billion. And they expect in the next 5 years for that market to grow at a CAGR, a compound annual growth rate of over 20%. And I think I've seen numbers floating around that this market by 2030 is supposed to be worth 2 trillion. So if Google can continue to hold this massive, not massive, but substantial market share, because they're one of the top 3 currently, right? If they just continue to hold the market share that they have, that's continued strong growth for them. And not to mention with generative AI and the need for AI infrastructure moving forward, that's going to grow this market even more. Okay, next we need to talk about Waymo. Um, as I said, still a super small part of Google's business. However, currently, this is the only provider that's currently doing paid trips. The only provider, and that's huge. I think Tesla is coming to Austin, where I live, in June. So I'm gonna have to go and try a Tesla robotaxi and see if I fear for my life. Then I can compare the two. But anyways, every week Waymo is growing the total number of driverless trips that they're completing. And I think a couple weeks ago they just hit the 200,000 per week mark. And I think it's important to understand how big this market is. I don't take a whole lot of Ubers, but if we look at the Uber gross bookings, I have this filtered to just mobility. It's in the data, it's clear. Over the past couple of years, this service has been growing incredibly fast. And when Waymo's, start scaling, they start making more of those, and people start enjoying those rides. Um, they're gonna start taking more and more market share here. Yes, I think ultimately there are gonna be a number of providers like Tesla and Zoox and a couple other ones. But ultimately, I think Waymos are going to be more efficient. They're going to be cheaper because they don't have a driver to pay, right? The margins are going to be higher. They're already showing signs that they're safer than humans. And overall, I'm just very optimistic about this, long shot, really. But I wanted to bring up this article that says ex-Waymo CEO shares why he still thinks Tesla can't compete with Waymo's robotaxis. So, as I understand it, this guy, the former CEO of Waymo, has been apparently been saying for years that Tesla can't compete. And in this article, he, restates his belief that Tesla can't compete. The article says in 2021, when John Krafcich was approaching the tail end of his career leading Alphabet's Waymo, the chief executive blew off Tesla as a serious competitor in the robotaxi race, dismissing Elon Musk's EV company as an automaker with a quote really good driver assistance system, which is shots fired essentially. 4 years later, his position remains the same. Tesla has aspired to compete with Waymo for nearly 10 years, but they still don't. Crafts said in email correspondence with Business Insider. They're a car company with a driver assistance system. They haven't delivered a single fully autonomous revenue generating ride yet, something Waymo is already doing a million times a month. Tesla last year made a splashy demonstration of its robotaxi prototype, Cybercab, a low-profile coupe with no steering wheel that seats 2 passengers, along with a retro-futuristic self-driving van. Wall Street wasn't impressed, and neither was Krafcich. And just to touch a little bit on the whole Tesla versus Waymo situation. So Waymo obviously uses LiDAR technology, which essentially brings the price or the cost of producing those cars up significantly. Tesla is trying to do a cyber cab without that technology, with just cameras and AI and um, yeah. But the question remains, is Tesla going to be able to pull it off? Are they going to be able to make it accurate enough and secure enough to be able to accurately or consistently provide rides? And, when they come to Austin in June, I will go see, you know, how effective, how good the product is essentially. But if it isn't accurate and it starts causing accidents and, you know, let's say people get hurt, that could hurt the cyber cab a ton. So it sounds good, their cars are going to cost much less. They're going to be able to get more cars out there faster. But it really it remains to be seen. Anyway, he continues by saying, if a company were serious about building a safe and accessible robotaxi business, it would look nothing like what was shown. The ex-Waymo CEO joins many in the AV space who say that safe and reliable autonomous vehicles require LiDAR sensors and cameras to help them navigate their environment. And that's about it for this article. But I want to go back and touch a little more on Uber with Waymo. So in a lot of cities, they're currently partnering with Uber. Um, and on March 4th, they announced that, uh, right into the future with Waymo on Uber in Austin. So they're partnering with Uber in a couple of cities. I think there was like one city that they decided to go on their own. But I think partnering with Uber here is the right move because Uber has such a huge network of users, which is hard to build out and it's going to take years. So if they can just partner with Uber and get into markets faster and just take a percentage of the rides that are being done and really get the most out of their vehicles and their fleet, it's going to be the way to go. But maybe I'm a bit biased because I also own Uber and I see it as a great um, step forward for Uber as well. Okay, moving on. So you probably know that over the past couple of years, Google has been facing a lot of, issues with the Department of Justice and various antitrust lawsuits and stuff like that. And just at the start of this month, we got this news that the DOJ still wants Google to sell off Chrome. I'm not going to talk too much about the specifics of, all of these lawsuits and what's going on. I just want to bring up the point that these big cases take years and years to work through and settle. So, this might not become a reality for Google until 5 or 6 years from now. And where's the business going to be at that point? And how much is this going to matter at that point? And after all, they're being asked to sell off Chrome, not give it away. So they're gonna get money for that. But I also want to bring up the point that in the late 90s, the government was asking Microsoft to split up their business essentially. That case took 6 years to work through. Microsoft ended up winning the case, and in that time, the stock tripled. And another situation I want to bring up was a lawsuit involving MasterCard and Visa, which went on the news came out sometime last year, but there was this lawsuit that went on for like 15 or 16 years. And just think about how much both of those companies have grown in that time. So by the time the lawsuit is eventually, worked through and a conclusion is made, you know, for a lot of these companies, it doesn't even matter anymore. But I mean, ultimately, I don't want to be too dismissive. Those are still things to worry about. The search dominance, right, with LLMs, the lawsuits, there's still worries. But ultimately, if you're buying this company today at a forward PE of 17, so much of that risk is already priced into the stock today. So if anything positive comes out of all of these cases, that's just going to be a boost for the stock price. And not to mention, if we go down here, their employee count, right? Almost 200,000. They have so many employees. I think it was Charlie Munger who called Google's headquarters like a rich kindergarten. So they're known for having a lot of employees and spending a lot of on their employees. But let's say they decide a couple years down the road to do something like, the year of efficiency, like Meta did, where they cut employees and really focus on profitability. They're just The point is there are so many things around the company that are just going to be positive catalysts moving forward. And during all of this weakness, as we saw, there's a huge buyer in the market for Google shares, and it's Google themselves. Okay, lastly, as I mentioned, I wanted to provide some projections and talk about my base case for this company. So, first, to run you through what all of this means, the EPS growth rate is what we expect the company's yearly EPS growth to look like. So, if we just look back here at the EPS, in the past 5 years, EPS has grown at 20% year over year. More recently, as you can see, that has been much faster. And I think, there is a boost there from how many shares they're buying back. And, obviously net income is increasing. So we're assuming a 20%, you know, averaged over the next 5 years, 20% growth rate. Let's say the EPS multiple, the PE ratio, which is currently 19 roughly. Let's say, the sentiment around the company doesn't change at all. It's still negative. And a company growing revenues and earnings so fast, this is undervalued, in my opinion. But let's say the company stays there. And, factoring these two things in, we should expect a compound annual growth rate of roughly 20% per year for the next 5 years. And in 2030, we could see this company be worth anywhere, around $380 a share. However, let's say I'm off on the EPS. I think I'm being pretty conservative here. They have search is showing no signs of declining yet, and their cloud business is growing. And as we talked about, the operating margins could be very strong there, so generating a lot of profits. Let's say I'm off on this. Let's increase this to 22%. And we can get close to 22% compound annual growth rate. Let's say by that time, there's not as many worries about lawsuits. Let's say we still don't see the disruption of LLMs in the Google search numbers. So investors feel a little more comfortable with holding this company, and it's, valued a little higher. Let's say the PE goes up to a 22. Then you could be looking at over a 25% compound annual growth rate. Let's say the business has really reached its maturity and it's being valued like a lot of the other big tech companies, a PE of 25, then you're almost at a 30 compound annual growth rate. Let's say the company does even better than we think. Let's say the EPS growth rate is 25% a year over the next 5 years. Then in 2030, the shares could be going for around $600. And we're looking at a compound annual growth rate of over 30%. So that's my point. If we bring these back down to 20 and 19, I personally think that these are very conservative estimations. And that's why I'm saying that, this company for me is a no-brainer buy today. Because even with low expectations, we're making a shitload of money. And at this point, so many bad things are already priced into the company. Things that we don't necessarily know are gonna go bad. We're gonna have to wait and see. Google is a company that I just bought. I bought it literally this week. It's currently the smallest position in my portfolio, but I expect that I'll be adding, honestly, quite a bit of money into this one and making this a core position in my portfolio moving forward. But as always, keep in mind that this isn't financial advice. You should always do your own research before making investments. But I would love to hear your opinion in the comments below. Let me know if you think I'm way off on what I'm thinking here, where you think I'm wrong, and what you expect for the future of Google. But that'll be it for this time. See you in the next one.